Which type of investment will make you the most money? Certain aspects of the market that are occurring right now are unprecedented in the course of history, but that won't always be the case. According to Austin Litvak, a licensed financial planner and the director of research at O'Brien Wealth Partners in Boston, Massachusetts, if you're an investor with a long-term perspective, the Federal Reserve is still credible, and it will get inflation under control. It is natural to be concerned about the state of your investments, particularly in a year that has witnessed significant declines in both the stock and bond markets. Moreover, entering the investment market during such volatility can make one feel anxious. Nevertheless, if you take a strategy to your investments that are suitable for your economic circumstance and time horizon, and that has the appropriate asset allocation for you, then you can ensure that you won't miss out on any potential recovery. Hello everyone, and welcome to another video on our channel. In today's video, we're going to discuss which type of investment will make you the most money. Stay tuned to find out. Now let's start our video. High-yield savings accounts. Online savings and cash management accounts provide better interest rates than traditional bank accounts. Cash management accounts are savings checking hybrids. They may pay similar interest rates as savings accounts and come with debit cards and checks from brokerage firms. Savings accounts are suitable for short-term or occasional savings, like an emergency or vacation fund. 6 monthly savings account transactions are allowed. Cash management accounts have equal or greater interest rates and additional flexibility. If you're new to saving and investing, keep 3 to 6 months of living expenses in this account before investing more. Online banks offer greater rates than conventional banks due to decreased overhead costs. Certificates of deposit. A CD is federally insured savings account with a fixed interest rate. A CD is for the money you'll need later. For example, a home down payment or a wedding. CDs could be an excellent solution if you want to grow your money safely for a specific purpose within a predetermined time frame. You'll likely pay a fee to withdraw money from a CD early. Don't buy a CD with the money you'll need soon. Like other investments, online banks and credit unions offer the best rates on term-length CDs. Money market funds. Money market mutual funds are an investment, not savings like money market accounts. Money market funds buy high-quality, short-term government, bank, and corporate debt. You're willing to risk money you may need shortly. Money market funds are a safer investment than stocks and are used to hold money for future investments. Money market funds are nominally an investment but don't offer the same rewards or risk as other options. MMF growth resembles high-yield savings account growth. Money market mutual funds can be purchased from a mutual fund provider or bank, but an online discount brokerage provides the most selection. If you're liking this content so far, please consider subscribing and liking this video. Now let's continue. Government bonds. A government bond is a loan to a government organization, such as the federal or municipal government, that pays investors interest over a fixed period, usually 1 to 30 years. Bonds are fixed income securities because of their regular payments. Government bonds are risk-free because the U.S. government backs them. Cons: in exchange for safety, government bonds don't offer a high return. With a 100% bond portfolio, reaching retirement or long-term goals would not be easy. Conservative investors desire portfolio stability. Bonds offer a ballast to a portfolio, usually rising when stocks go down, explains Delia Fernandez, a certified financial advisor in Los Alamitos, California. Bonds, fixed income, and lower volatility make them popular with retirees who may not have enough time to weather market falls. You can acquire individual bonds or bond funds from a broker, the underwriting investment bank, or the U.S. government. Our guide to bond investing can help you decide which varieties to buy. Corporate bonds. The primary difference between corporate bonds and government bonds is that with corporate bonds, you are lending money to a corporation rather than to the government. As a consequence, the government doesn't guarantee these loans, making them a more precarious choice. And if it's a high-yield bond, also frequently referred to as a trash bond, these can be far riskier than other bonds, taking on a risk/return profile that is more similar to stocks than bonds. Investors searching for a fixed income instrument with the potential to offer greater returns than government bonds, but are ready to take on a bit more risk in exchange for those higher returns, can consider municipal bonds. When yielding on corporate bonds, the bigger the probability that the issuer will be forced to close its doors, the better. On the other hand, bonds issued by substantial, established businesses will often have a lower yield. It is up to the individual investor to choose the optimal risk ratio to return for their particular situation. You can purchase corporate bond funds or individual bonds via an investment broker, just like government bonds. Well, that's all for today's video. Tell us in the comments section how this video was. I hope that you found this one interesting. You can subscribe and watch more videos on our channel to keep up with more content. We'll see you in the following video with some more notable celebrities, facts, and stories. Until then, stay tuned.